Hello, I'm Jared Nelson, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Big trading ideas often depend on market conditions. At this point, informed listeners will know we are in one of the most bullish stock markets the world has ever seen. The Nasdaq Composite blasted to new highs yet again after a short one-week consolidation. The speed at which the Dow rebounded from its near-term lows shows plenty of ready buyers waiting at the sideline. It is not difficult to see why. Who wants to miss out on a once-in-a-decade bull market? Retail investors are rushing in while institutional investors are sitting on sizable profits after a year-long rally. Speculative instruments like Bitcoin has rebounded to all-time highs at $40,000 and even pushed higher off the news that Tesla was accepting it as payment, adding a sizable chunk to its balance sheet. Last week, we talked about buying crypto miners. This trade is a leverage play on Bitcoin. As long as Bitcoin continues its spectacular bull run, the trade should work out well. In a market upswing, there is also one characteristic that investors participate heavily in: IPOs. IPOs, short for Initial Public Offering, increase in numbers and scale during the latter phase of a bull market. And make no mistake, we are in one. Last year, Airbnb, the rental platform, sought a listing even as the second wave of COVID-19 was overwhelming hospitals. Its $47 billion valuation more than doubled on the first day as enthusiastic investors sought its shares. And in Hong Kong last week, Kuaishou Technology, the Chinese social app, opened up almost 200% above its IPO price. By the end of the session, the company was worth a staggering $158 billion US. Across the Atlantic in the UK, the number of IPOs is rising and attracting good valuations. Activity has been the highest since 2006. Now, did you know there were 480 IPOs on the U.S. stock market last year? This is the highest number ever. In fact, it is almost 20% higher than the number of IPOs in 2000 at the height of the dot-com bubble. It's like we're back to the IPO trading game back in the 90s, flipping new issues for a quick profit. The number of IPOs this year is already running at a level far higher than in 2020. Dating app Bumble is set for an IPO on February 11th. Its share price is expected to jump above the IPO price. And there are a large number of companies waiting in the wings to go public. Some of the big names in the pipeline this year are Roblox, the gaming company, Coinbase, the crypto exchange, Stripe, the payment tech company, and Robinhood, yes, that much talked about broker. For readers not wanting to buy each individual issue, there is one interesting ETF called the Renaissance IPO ETF that holds only newly listed companies. Its ticker is an apt one, IPO. Trackstar IQ, our proprietary search tracking tool, frequently shows IPO as one of the most researched ETFs by financial professionals. The ETF mostly holds large-cap IPOs. Stocks older than 24 months are dropped from the portfolio. The $980 million ETF was trading in a defined price range until March last year, when prices started to rise steadily. The ETF soared by more than 200% in less than a year, and its price trend is still bullish. All in all, it is clear that the current investor sentiment is positive enough to support a large number of new securities coming into the market this year. But a seasoned investor knows that the market sentiment can turn suddenly. No one is going to ring the bell that a top has been reached. More importantly, not all IPOs are a one-way bet to riches. Many IPOs have crashed shortly after their debut. Remember Facebook in 2012? Prices slumped 50% in just a few short months after its IPO. Another example, Snap in 2017, the stock closed at $27 on its first day, only to see it collapse 80% in the following months. Buying into an IPO is not guaranteed to make you money. Warren Buffett, the legendary investor, is famous for avoiding IPOs. He disliked the hype surrounding an IPO because the pricing is often too aggressive for a value investor like him. He said once that an IPO is a situation whereby the seller decides when to come to market in most cases, and they don't pick a time necessarily that's good for you. It's true. Apart from raising cash from new investors, an IPO provides an exit for many early investors. They will try to maximize their returns by hyping the company prior to the IPO. Many IPO investors lost money buying into this hype. Bear in mind, too, that as the bull market stretches further, the quality of companies behind the IPO will probably drop. These Johnny-come-lately companies focus on taking as much money from investors as possible. They are not here for the long term. One strategy to trade IPO is not to buy on the first day. Wait for a market weakness to buy. And be sure that the new listed company has good long-term growth prospects. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.